Welcome to the deep dive. Today we're jumping into fix and flip financing.
Mm-hmm.
We've got a source called Fix and Flip Financing Essentials, and there's also a quick mention of something called Joe Starcher funding.
Right.
Our mission here is pretty straightforward. Let's quickly get the essentials of how this funding works, see what it's all about, and maybe spark some ideas for you if you're interested in real estate investment.
Exactly. We want to get to the core, how it functions and why it's such a popular tool for certain investment strategies.
Okay, so let's start right there. For anyone new to this,
Yeah.
what exactly is fix and flip financing in simple terms?
Sure. It's basically a short-term loan. You use it to buy a property, usually one that needs some work. Then you renovate it, and the plan is to sell it pretty quickly for a profit.
So build for speed.
Definitely.
Yeah.
Rapid turnaround is the name of the game.
Okay, that fits with what the Essentials source highlights. Quick approvals and fast funding. Getting money in days, not weeks. Why is that specific speed factor so vital?
Well, in the real estate market, especially for these kinds of deals, opportunities pop up and disappear fast, really fast.
Right. Blink and you miss it.
Exactly. So getting financing quickly means investors can actually pounce on a good deal when they see it before somebody else snaps it up. It's all about timing.
And it's not just for buying the place, is it? The source says it covers purchase and renovation costs.
Right.
One single loan.
Yeah, that's a big advantage. Instead of juggling, say, a mortgage for the purchase and then maybe a separate line of credit for the rehab.
Which sounds complicated.
It can be. This rolls it all into one package. It really streamlines the money side of things for a project that's moving quickly anyway.
Makes sense. Now, these projects aren't meant to be long-term rentals or anything. So what kind of loan terms are we typically talking about?
Usually you're looking at somewhere between, say, 6 months and maybe 18 months.
Okay.
And what's interesting is how they often try to tailor that term to fit the project's expected timeline. So it's financing really built for purpose for that specific short-term flip strategy.
Right. Designed for the job. So how does using this type of financing potentially lead to better returns? The source mentions increased ROI potential. Is it just about speed?
Speed helps, but it's also about leverage. Because you're not necessarily tying up, all your own cash in one deal.
Wow.
It frees up your capital. So you could potentially do maybe 2 smaller flips simultaneously instead of just one larger one.
Spreading the resources and the risk, I suppose.
Exactly. Diversifying a bit. And yeah, if you manage them well, you could potentially increase your overall profit. It allows for scaling.
Okay, interesting. Now, what about credit scores? Does your credit need to be absolutely perfect to get this kind of loan? But the source mentions asset-based lending. What's that mean here?
Yeah, that's a really key point and a difference from standard home mortgages. Well, your credit history still matters, of course.
Sure.
These lenders often put a lot more weight on the property itself, specifically its potential value after you've fixed it up, the after repair value, or ARV. So the asset, the property, is a huge factor. They also really want to see that you have a solid plan for the renovation.
So it might open doors for investors who maybe don't have that top-tier credit score.
Potentially, yes. If the deal itself looks strong and the numbers make sense based on the property's value, it can be more accessible.
So pulling it together, who is this really for? Who is the ideal person for a fix and flip financing?
Well, the Essentials Guide puts it pretty clearly. It's ideal for real estate investors looking to buy undervalued properties, renovate them, and sell at a profit quickly and efficiently.
Straightforward enough.
Yeah. If that sounds like your strategy, this is definitely a financing tool you should look into.
And just before we wrap, there was that name, Joe Starcher funding. Any idea what that relates to?
Well, based just on the name appearing in the notes, it's most likely a company or maybe an individual broker that offers this kind of fix and flip financing.
Okay.
We don't have more detail from the source material, but it's, a name to jot down if you're planning to research providers in this space.
Got it. Okay, so let's do a really quick recap for you listening. Fix and flip financing offers speed getting funds fast. It covers both the purchase and the renovation costs, usually in one loan. The terms are flexible, typically short, aligned with the project, and can help boost your potential return by letting you leverage your capital. Plus, it often focuses heavily on the property's potential value, which might help even if your credit isn't perfect.
That sums it up nicely. It's a financial tool really engineered for creating value quickly in real estate.
So here's something to think about. With financing that's actually designed for transforming properties fast, what kind of opportunities, maybe ones you thought were out of reach, could now be possible for you? And perhaps looking into resources, maybe even like that Joe Starcher funding name we saw, could be a place to start exploring. Thanks for diving deep with us today.